Hello everyone, welcome to this video on AS A-level accounting past paper analysis. So in this video we are going to analyze the May-June 2022 paper. We will be analyzing paper number 11, 12 and 13 in this video. To gain or to benefit the most out of this video, the process to do it correctly is first you have to make sure that your concepts are perfect, or at least they are good enough to solve a paper. So you'll have to study all the chapters properly, because before attempting any paper, any question paper, past paper, you have to make sure that your concepts are good. Otherwise there's no point in solving a question then midway just looking at the marking scheme because you're not sure of the answer. Study properly, attempt the paper, then check with the marking scheme, learn from your mistakes and improve. I have already put up learning videos on all chapters of IGCSE, AS and A-level accounting, so make sure you use them. If you want access to more learning content, more questions, answers, MCQs, then you can consider buying the online course also. You will find the link in the description box below. So assuming that you've already solved the paper, you can continue watching this video and see how do I analyze the question, or how are you supposed to analyze the question in the exam and solve it, and whether you made a mistake. Make sure you understand the concept, understand the reason why you made the mistake, so that in exam you don't make the same mistake again. So let's begin with paper number 11 first. First question, which statements are correct? So in such questions, there may be confusion. Sometimes reading a statement, there are statements that seem correct at the first instance. When you read them, they seem correct, but they might not be correct. So read all the sentences carefully, and then we'll see at the options to see which option is correct. A book of prime entry is also part of the double entry bookkeeping system. This statement is partly correct because the cash book and the petty cash book is a part of the double entry system, because the balances from these books are also taken in the trial balance. But a student may be confused whether it is correct, it is not correct. So let's say you have a doubt here, never mind. Second statement, all sales made by the business are included in the sales ledger. This statement is not correct because sales can be of cash sales and credit sales. Cash sales are not entered in the sales ledger, only credit sales are entered in the sales ledger. Ledger accounts for income and liabilities have credit balance. This is absolutely correct. Trade discounts appear in the income statement. This is not correct. So I'm 100% sure about the statement 2 and 4, they are not correct. So I will definitely not choose any option that has 2 or 4 in it, because I'm supposed to choose the correct statement. So A is out of question because it contains 2. Then C is out of question because it contains 4. D is out of question because it contains 4. So you see, even if you're not sure about the first statement, you still get your correct option by eliminating the wrong ones. So yes, option or statement number 1 and 3 are correct. Second one, which accounting concepts are not reasons for including depreciation in the income statement? So what are the reasons for including the depreciation in the income statement? The matching concept and the prudence concept. These are the two main principles because of which we record depreciation in the income statement. Materiality is about insignificant items or insignificant assets not being recorded as non-current assets in the books because the value is too small, it's insignificant. So sometimes because of materiality, we don't record something as a non-current asset. So materiality, there can be a doubt in the mind of students. So let's keep that as doubtful. Then realization, definitely realization has nothing to do with your depreciation in the income statement, because realization is about when to record the incomes in the income statement, the revenue from sales or for providing services. So 4 is definitely not a reason for including depreciation. So I'm sure about that. 2, I'm not sure. Let's look at the options. So since 4 is there in A, my doubt is at A and it is at D. But when I go to A, here there is also number 1, which is matching, which is not the correct answer. So looking at the options, the best option here is D. Realization is not the concept. That's the answer they're looking for. On 1st Jan 2019, a non-current asset was purchased at a cost of 290,000. Delivery and installation cost of 10,000 were paid. So the total cost of the the non-current asset is 300,000. So let's write it here. Reducing balance method is used to depreciate the asset at rate of 20% per annum. Full year's depreciation is charged in the year of acquisition, none in the year of disposal. On 31st December 2021, non-current asset was sold. Disposal costs were so much. So if it is sold for 205,000 and disposal cost is 5,000, so the net price that you receive for the disposed of asset is 200,000. What was the profit on disposal? So 300,000 is the cost. On this you will apply 2 years depreciation, 2019 and 2020. So you'll calculate depreciation using reducing balance for 2019 and 2020. Why not 21? Because the asset is sold in 2021 and it says none in the year of disposal. When you calculate the depreciation for 2 years, then you calculate the net book value, which is the cost minus depreciation. Then compare that net book value to the sale value, which is 200,000, and then you should get your profit or loss. Obviously it looks like there's a profit because question is about profit on disposal, and you should get your correct answer. A sole trader purchased a machine costing 30,000 with an estimated residual value of 5,000. It is expected to have a useful life of 5 years. Cost is given, estimated useful life is 5 years, and scrap value, estimated scrap value is 5,000. At the end of 4th year, machine was sold at a profit of 200. So depreciation is straight line, fine. Full year's depreciation in the year of for each year the asset is owned. Okay. What are the sale proceeds? First, calculate the annual depreciation, which is 30,000 cost minus 5,000 scrap value, 25,000 divided by 5. $5,000 is 1 year's depreciation or annual depreciation. For how many years have they used it before selling? So it was disposed of at the end of 4th year. So how many years depreciation will you charge? 4 years, because it says that depreciation is provided for each year the asset was owned. Even though it's sold in 4th year, it was not owned for the whole part of the 4th year, but still you have to provide depreciation for 4 years. So 20,000. If 20,000 is depreciation, cost is 30,000. So how much is the net book value? 10,000. If net book value is 10,000 and profit on disposal was 200, so how much was it sold for? So that you get a profit of 200. Obviously 10,000 plus the profit, 10,200. So option is C. So 5th one, which statement about control account is not correct? Only cash book entries need to be checked to identify the errors, which is not a correct statement. They help to identify where errors have been made. This is a dicey statement because yes, if you prepare the sales ledger control account, it gives you an idea that the error is there in the sales ledger. And if the purchase ledger control account will help you determine whether there is an error in the purchase ledger or not. So by that sense, this statement is correct, but where exactly in the sales ledger or purchase ledger, that it does not tell you. So it's a dicey statement. Let's put a dot. So at the end, we may get some clarity. They make the totals of trade receivables and trade payables more easy to obtain. Yes, you can say that the totals of transactions with receivables and payables are there in one single account. You have the total sales, total returns, total cash collected or cash paid, the closing balances all at one place. So it is correct. They reduce the possibility of fraud. Yes, because when control accounts are prepared, there's a check in place. So any fraud that might even happen, or if there's a possibility that fraud might happen, it might get detected. So it reduces the possibility of fraud. So statement A looks the most incorrect one, or it's the incorrect one, even statement B is correct. At the end of financial period, the trial balance of a business did not agree and the suspense account was opened. Fine. The following was then discovered. Some errors are given here. After adjusting these items, the suspense account was cleared. It means there's no balance at the end. What was the opening balance in the suspense account? So let's quickly prepare a suspense account. There's no balance at the end. Let's put up the entries. We'll get then the opening balance, which will be the answer. A check for 7,800 was correctly entered in customer's account but had been debited in the bank account as 7,000. It should have been debited as 7,800 but debited as only 7,000. So bank should be debited by extra 800 and suspense should be credited by 800. So on the credit side I have bank 800. A credit purchase of 2,500 omitted from the books. This will not affect the suspense account. It's an error of omission. Discount received 9,600 has been entered on the debit side of discount allowed account. It should have been entered on the credit side of discount received, but it is entered on the debit side of discount allowed. So if you talk about the journal entry, the journal entry will be suspense, debit, discount allowed and discount received, both credited by 9,600 each. So the total debit in suspense will be 19,200. So debit side of suspense, discount allowed 9,600 and discount received 9,600. Sales account had been overcast by 18,200. So to correct this, you'll have to debit sales and credit suspense. So suspense credit side, sales 18,200. So let's see which side is more. The debit side total is 19,200 and the credit side total is 19,000. So to balance this out, it is obvious that the difference in trial balance, which is the first entry, would have been on the credit side as 200. So our correct option is 200 credit. Which statements about a bank reconciliation are correct? Cleared checks are excluded, correct, because checks that are already cleared, they also recorded in the cash book, they are not included in the bank reconciliation. So this is a correct statement. It locates all the errors, not really. It does not locate the error. Locating the error means it tells you exactly where an error has happened, not really. Bank reconciliation statement does not help in that. It locates any fraud, again not really, because it only helps you to understand the difference between the cash book balance and the bank statement balance. It does not detect or locate the fraud for you. Uncredited deposits are included, which is correct. So 1 and 4 are correct. So option B. At the beginning of financial year, inventory was valued at 15,000. During the year, sales of 21,000 and purchase of 18,000 were made. All inventory was stolen on the last day. Goods are marked up by 50% to calculate the selling price. What is the cost of inventory stolen? Okay, if sales is 21,000 and markup is 50%, so how would I calculate my cost of sales? 21,000 divided by 150 into 100, so 14,000. Now, can we calculate the cost of inventory stolen? Yes, cost of sales is equal to opening stock plus purchased stock minus the stock that is lost stock, and minus the closing stock. So we have the opening as 15,000, purchases as 18,000, lost stock we don't know, we have to find. Okay, on the left hand side, cost of sales we calculated as 14,000 and there is no closing inventory, so that's 0. So let's say lost stock is X. So just calculate X, which is lost stock, is equal to 15 plus 18, 33, 33 minus 14, 19,000. So option C. Ninth, what will be used to calculate the general provision for doubtful debts? Total trade receivables only, fine. Total trade receivables less any irrecoverable debts. Okay, so this is even better than A, because bad debts, whatever has happened during that, has to be deducted. Then you can calculate your doubtful debts. C, total trade receivables less provision for specific doubtful debts. So yes, let's say out of all your debtors, there's a debtor that is specifically doubtful. Apart from your general provision, the rate that you apply on your debtors, specifically one of the debtors you know that it is doubtful, so you will not be applying that general rate onto that specific debtor. So you will have to deduct the value of the specific debtor from the total trade receivables to arrive at the debtor at which you will be applying the general rate of provision for doubtful debts. And option D, you deduct both irrecoverable debts and provision for specific doubtful debts. So option D is the best out of all these. At 31st December, a business had calculated draft profit of 57,500, then discovered following adjustments when necessary. What is the correct profit? Inventory valued at 2,400 was damaged and now had a resale value of 1660. So if closing inventory is reduced by this amount, this will reduce the profit. So minus 740. Rent receivable included 400 prepaid for the next year. When from the income you reduce prepaid income, so again the effect is minus 400. Provision for doubtful debt needs to be increased by 890, so again minus 890. So from the profit 57,500, when you deduct these values, these three values, see which option you get. Looks like it's option A. Yeah. Closing inventory has been undervalued. What is the effect on financial statements? On the total current assets and profit for the year. So when closing inventory is undervalued, profit for the year will be understated. So, and total current assets will obviously be understated. So option D, because inventory is a part of current assets in the balance sheet, and the undervalued closing inventory increases the cost of sales and it decreases the net profit. Twelfth one, a sole trader has provided the following information: net assets. Net assets means capital on opening and closing during the year, drawings, so cash introduced, motor vehicle introduced. What is trader's profits? Which is simple. So using incomplete records formula, profit is equal to closing capital minus opening capital plus any drawings minus additional capital. So you have the closing capital 24, opening capital 10, drawings 3,200 and additional capital, these two amounts total 8,500. Yes, even motor vehicle introduced by the owner, even though it's not in cash, it will be a part of additional capital. So you can do the calculation and see which option is correct. What will apply to partnership when there is no partnership agreement? Partnerships are entitled to interest on capital they have contributed to partnership. Not correct, because in absence of agreement, interest on capital is zero. Partners are not charged interest on drawings. It's a correct statement. Interest on drawings is zero. Partners are entitled to salaries, which is not correct because salaries become zero if there's no agreement. Partners are not entitled to interest on loans, which is not correct. They are entitled to interest at the rate of 5% per annum if there is no agreement. So option B is correct. X and Y were in partnership, sharing profits and losses equally. On 1st Jan, P was admitted into partnership. He contributed 20,000 cash, 10,000 current assets or other assets. Okay. Non-current assets were revalued upwards by 12,000. So there was a profit on revaluation of 12,000. There's no adjustment for goodwill. Fine. Profit and losses continue to be shared equally between the partners, three partners. What was balance on P's capital account after all the entries? P is basically the new partner. So in new partner's capital account, what adjustments do you have? You have the capital adjustment where he brings in capital plus any adjustment for goodwill. Now there is no goodwill. So what will be the balance in P's capital? Only the capital introduced by P, which is 30,000 C. Daisy, Freddy, Harry, who shared profits losses equally, had been in partnership. Harry decided to retire. Fine. Harry's capital and current account had credit balance of 40 plus 8, total 48,000 on retirement balance. The total assets of the partnership had a book value of 98,000 but a realizable value of 116,000. So there is a profit on revaluation at the retirement. And how much is the profit? It is 18,000, the difference between 116 and 98. Which amount did Harry receive from partnership on his retirement? If there was goodwill, we would also account for that, but there's no goodwill. So 48,000, which is the balance in his capital and current account, plus his share of revaluation profit. And how much is his share? Equally. So 1/3 of 18,000, which is 6,000, 6,000 plus 48,000, D, 54,000. Company made a bonus issue of one ordinary share for every 5 ordinary shares held. What is the effect on share capital and reserves and the net assets? So basically this is equity, and net assets is assets minus liability, which is also equity. Basically they're just trying to confuse you. So when a bonus issue is made, what happens? You just convert one form of equity, which is one of the reserves, you convert into permanent share capital. So there's no change in equity, no change in net assets. So D is the correct option. 17. At the end of his first year of trading, company provided the following information: dividends paid during the year, and at the end, okay, debenture interest paid, and at the end, director salary fine. How much do these items reduce the profit for the year? So in the income statement, what all will you consider? Obviously, you'll not take into account dividends. They are taken in statement of changes to equity. They are talking about profit for the year, so we only see what is taken in income statement. Debenture interest paid 4,000 and accrued 1,600. So total interest that you will record in income statement 5,600, and director salary obviously you'll record 10,800. So how much will your profit reduce by? 16,400. So option number C. 18th, M Limited has the following balances on 1st Jan 2021. Ordinary share capital 500,000. Okay, share premium, general reserve, retained earnings. During the year, interim dividend of $0.02 per share was paid. Transfer to general reserve happened. Company made a profit of 80,000 fine. What is the maximum additional dividend payable per ordinary share? So dividend can only be paid if the company has balance in either general reserve or retained earnings. So there was a transfer of 20,000 to the general reserve. So out of 50,000, it got increased by the profit that was earned during the year, but it got reduced by the transfer to general reserve. And there was also an interim dividend payment of 0.02 per share. So 0.02 into 500,000, which is 10,000. So I'll deduct 10,000 also. So after all transactions, what is the balance in retained earnings? 130 minus 30, 100,000. On top of this, we also have general reserve, which can also be used to distribute dividend. 40 plus we transferred from retained earnings 20. So 100 plus 60. So totally $160,000 $160,000 worth of reserves are there, which can be distributed as dividend. So this $160,000, we want how much can it be distributed per share. So if we divide the entire $160,000 over 500,000 shares, how much will we get? That would be your answer. So C. Which ratios are efficiency ratios? Expense to revenue ratio, it is profit ratio, it's not an efficiency ratio. Turnover, inventory turnover, and non-current asset turnover, yes, turnover ratios are always efficiency ratios. Return on capital employed is again a profit ratio. So the correct is 2 and 3. Following information available for limited company: closing inventory, increase in inventory from the start of the year 50%, rate of inventory turnover 8 times, gross profit for the year 200,000. What is the company's revenue that we have to calculate? Okay, let's see how we can approach this question. So whenever such a question is given, whatever the ratios, let's try to write the formula of the ratio, and then we'll see can we arrive at something. So here here rate of inventory turnover formula, the number is given 8 times. If we look at the formula, it is cost of sales upon average inventory. Let's see, can we somehow get either the cost of sales or either the average inventory? If yes, we get the other number which is missing, because we already have on the left hand side 8 times. Average inventory can be calculated. Why? Because closing inventory is given and it says increase in inventory from the start of the year 50%. So if closing stock is 30,000 and they're telling you closing stock is 50% more than the opening stock, so how much would be the opening stock? It will be 20,000, because 20,000 plus 50% 10,000 gives you 30,000. So how much is the average? 25,000. So in this formula, if we replace 8 is equal to cost of sales upon 25,000, so we get cost of sales is equal to 200,000. Cost of sales is 200,000 and gross profit is 200,000. So how much is the sales? So this 200 plus 200,000 cost of sales, sales is equal to 400,000. If gross profit is 200 and sales is 400, okay, so we need the sales. So sales is 400,000, option B. Question 21, which item is a direct cost? Okay, so from 21 onwards we have costing. Carriage inward on production materials. Okay, before looking at the options, what is a direct cost? A direct cost is any cost that you incur directly in the production process so as to prepare your final product. Any cost that is not really required to produce the product, that is not a direct cost, it is an indirect cost. So carriage inward on production materials, yes, it's a part of the raw material cost. Cleaning materials for factory is not a direct cost. Why? Because cleaning materials is required to clean the factory and not to produce the product. So that's the difference between direct and indirect cost. Factory rent is not a direct cost because it is not directly required to produce the product. Wages of a factory manager, no. If this was wages of a factory worker, yes. So A. A business pays its employees $2 for each unit of X, $3.2 for each unit of Y. Monthly output is 1800 of X, 1000 of Y. Factory supervisor is paid $1000 per month. What is the direct labor cost? So wages paid to factory workers is direct cost, but wages paid to factory supervisor is not a direct cost. It's an indirect labor cost. So you just need to calculate how much will be paid for product X and product Y. So for X, 1800 units into $2, for Y, 1000 units into $3.2, add them and you'll get your answer. 23. An employee works a 35-hour week and is paid at an hourly wage rate of $24. So basic pay is 35 into 24. In addition to the basic pay, she receives bonus of 25% of the hourly rate. Hourly rate is 24. 25% of that is $6. So bonus payment rate is $6 per hour. This is calculated using the time saved against the target unit. So whatever time is saved, that those many hours into $6 will be her bonus. Each unit should take 15 minutes to produce, fine. For a 35-hour week, she produced 170 units. So if we take 170 and try to find out how much should be the time taken to produce these 170 units. So time for 170 units, 170 into 15 divided by 60. If you don't divide by 60, you'll get it in minutes. But to make it simple, we are dividing it by 60. So we get 42.5 hours. To produce these units, it should have taken 42.5 hours, but she took only 35 hours. So how much time did she save for the business? 7.5 hours. So on this, she will be getting a bonus payment of $6 per hour, which makes it $45. So $45 is the bonus. And how much is the basic? Basic is 35 into 24, which is $840. So 840 plus 45, 885 as of now. I'm talking about this 840 and this bonus. But 2 units were rejected and her total pay was reduced by $2.5 per unit. Obviously, if you damage the resources of the factory, the manager will charge you for that. How much was she charged? Since 2 units she damaged, 2 into 2.5, $5 was reduced. So reduction. So 840 plus 45 minus 5, option B, 880. A manufacturing business uses direct labor hours to calculate its overhead absorption rate. What are the causes for over absorption of overheads? If you remember, there are 2 reasons possible for over absorption of overheads. One is actual labor hours are greater than what was budgeted, or the actual overheads are less than what was budgeted. So let's read these statements. More labor hours have been used than budgeted. Yes, option 1 is correct. That falls under our first statement. More products have been produced than budgeted. This could be the right statement, may not be the right statement. It could be because more labor hours were taken to produce more output. Second statement is linked to the first statement. So we have a doubt here. More products have been sold. Not correct or not relevant, because absorption is related to production and not what is sold. So 1 is definitely correct. So let's see in which options we have 1. We have it in A, we have it in B, and we have it in C. So it's definitely not D. Then let's see in which option we don't have statement number 3, because that is definitely not correct. So we will strike out A and we will strike out C. So we are left with B. So probably even the second one is correct. Yes, second one is correct, but there may be a doubt in your mind. So you can eliminate the wrong options like this and choose the correct option. Okay. Following information is 25. We're doing following information is provided by a company for a month. Actual labor hours worked, budgeted direct labor hours, budgeted overheads under absorbed. What is the amount of actual overhead expenditure? Fine. To do that, first you'll have to calculate overhead absorption rate, which is budgeted overheads upon budgeted labor hours, 80,000 divided by 5, $16 per hour. Then you need to calculate the absorbed overheads, which is equal to actual labor hours 4,500 into $16. So when we calculate that, $72,000 is the absorbed overheads, and they're telling you that overheads have been under absorbed by 12,000. So definitely actual overheads were more than the absorbed overheads. That's why it becomes under absorbed by 12,000. So 72 plus 12 will give us actual overheads, which is 84,000, option D. What is contribution to sales? What is the contribution to sales ratio used to calculate? So definitely not overhead absorption rate. Break-even point, yes. In the formula for break-even point, we have its use. Profit for the period, probably it could be used somewhere, but A is definitely a better answer than C. And value for inventory, no. So A. Following information relates to the first year of operation of a business: production, sales, unit selling price, variable cost, selling expense per unit, and total manufacturing overhead. Fine. What is the value of gross profit if the business is using absorption costing? What is the difference between absorption and marginal costing? In absorption costing, the fixed production overheads will also be used in the valuation of inventory and will be considered, or will be absorbed by the inventory and will be considered in calculation of gross profit. But in case of marginal costing, the fixed production overheads will not be taken as a part of inventory. They will be fully deducted in this year itself when calculating the gross profit. But we have to follow absorption costing. So how much would be our cost of sales? Our cost of sales will be the total cost of producing the output, which is variable cost of $4 plus fixed overheads of $13,000, but it was spent on producing 5,000 units. So 13,000 divided by 5,000, $2.6. This becomes our total cost of sales, cost of producing the output. And our sales is how much? $10. So how much is the gross profit per unit? $3.2. This 3.2, when you multiply with 4,000, so you get 12,800, which is not here in our options. Okay, this is not 3.2, this is 3.4. So 13,600. So yes, option C. What if this question was a marginal costing question? Then how would you solve it? You would not take into account the fixed manufacturing overhead. You would only see gross profit is equal to selling price minus the variable cost, which is 6 into 4,000, 24,000. Minus the fixed cost fully. So that gives us 11,000. So you do this if it's a marginal costing question. I hope you understand the difference. In the first case, what we did, we distributed the fixed cost over the inventory and we carried forward the fixed cost that is related to the closing inventory to the next year by considering it a part of the closing inventory. But in marginal costing, we are completely deducting the fixed cost in the current year itself and not carrying forward anything to the next year. So that's the difference in absorption costing and marginal costing. A company makes and sells a single product type which has a selling price of $20 per unit. Okay, selling price, variable cost is $8, fixed costs are $7,000. Company wishes to achieve a profit target of 20,000. How many units should be produced and sold? So the formula is simple. Units to be produced will be equal to the fixed cost plus the target profit 20,000 divided by contribution per unit, which is 20 minus 8, so $12. So 27,000 divided by 12 and you get your answer. Last year, a company sold 2,000 units and made a contribution of $50 per unit. Okay, after deducting fixed cost, profit was 60,000. So contribution was $50, 200,000. Okay, so total contribution was how much? 100,000, and profit was 60,000. So that tells us that the fixed cost is 40,000. Just calculating it, we may need it later or we may not need it. Just analyzing the question. This year sales volume increased by 10%. So this year the company sold 2,200 units. Contribution per unit decreased by 5%. So last year it was $50. This time it will be $47.5. Total fixed cost increased by 25%. So 40,000 increased by 25% means it increased to 50,000. So when you do the calculation, you will get your answer. Which statement does not apply to budgeting? Budgets are plans that guide management to achieve strategic objectives. It's correct. It's a plan for future. Budgeted outcomes should be compared with actual results so that the effective action can be taken, which is also a correct statement. In A level, you will study standard costing, which is about comparing the budgeted performance with actual performance and calculating the variance. So statement B is also correct. Budgets should be easily achieved so that managers appear to be efficient, which is not a correct statement, because budgets should be competitive. It should not be very difficult to achieve, else it will lead to lack of motivation, and it should not be very easy also, otherwise there is no motivation to the managers and employees to put in their best effort. So C is not correct. Management should communicate and coordinate budgets across all levels of management. That's correct, because then only everywhere in the organization, or everyone in the organization will be aware where the organization is heading, what are its goals, and everyone can work in the same direction. So C is the correct option here. It's not the right statement about budgeting. So that completes our paper number 11. Now let's go ahead and do paper number 12. So starting with question number 1, which accounting concept states that revenue can only be recognized after it has been earned? So anything related to revenue recognition or when to record revenue is always realization concept. A sole trader has changed the method of depreciating his machinery from reducing balance in year 1 to straight line method in year 2 of trading. The same percentage rate of depreciation is used in both cases. Okay, what is the effect on the net book value of the machinery and the profit for year 2? So earlier they were following reducing balance, now they are following straight line method. So when you shift from reducing balance to straight line, your depreciation value will increase, because in reducing balance you calculate depreciation on net book value, while in straight line you're calculating on cost, which is higher. So profit for the year will be definitely lower, and if depreciation amount is high, the net book value will be less. So profit is lower, net book value is lower. Correct answer is option D. Third one, Paul has a year end of 31st December. On 1st Jan 2020, he bought a non-current asset for 10,000, sold it on 1st Jan 2021 for 8,500, which is after 1 year. He usually depreciates 10% per annum. A full year's depreciation is given in the year of acquisition, none in the year of disposal. Okay, he forgot to provide for any depreciation on his non-current asset. What is the effect of this error on Paul's profit for the year of 31st December 2021, basically in the year in which the asset was sold? Since In the year of disposal, there is no depreciation provided. So question of depreciation in 21 does not arise. We have to see how much would be the profit or loss on disposal if he provides depreciation and if he does not provide depreciation. So if he provides depreciation, his loss on disposal would be 10,000 minus depreciation for 1 year 1,000, and he sold it for 8,500. So 500 would be the loss. But if he does not provide depreciation, how much would be his loss? His loss would be 1,500. 10,000 minus 8,500. This 1,000 will not be recorded. So 10,000 minus 8,500, 1,500 will be the loss. So if you see, the loss on disposal is $1,000 higher in case you don't provide the depreciation. If loss or the expense is $1,000 higher, it means the profit is $1,000 lower. So correct option is option B. Students can make a mistake here. The moment they get this $1,000 higher, the loss on disposal, they might incorrectly choose option A. But it is incorrect. Why? Because they're asking the effect on profit and not the amount of loss on disposal, the difference in loss on disposal. Question number 4. A business depreciates its machinery at 10% per annum using straight line on month by month basis. The financial year ends on 30 June. Asset was bought on 6,600 on 1st April, which is the cost. Sold on 30th November next year. Profit on disposal was 350. What are the sale proceeds? First, we need to calculate the net book value, which will be cost 6,600 minus depreciation that is totally provided when the asset was being used. So how many months the asset was used? If you count from 1st April to 31st March of next year, 2021, it will be 12 months. Then from 1st April 21, if you count until 30th November, it will be another 8 months. So 8 plus 10, 20 months. So 6,600 into 10% into 20 by 12. So the net book value that we get is 5,500 and the profit on disposal is 350. So the sale proceeds will be 5,500 plus 350, 5,850, option number C. Question number 5. Why does a business maintain sales and purchase ledger control accounts as a part of the double entry accounting system? It allows a trial balance to be prepared easily from the nominal ledger. Let's see. For preparing the trial balance, you need your account balances from all the ledgers. So probably this statement number 1 is not really correct. It can involve separate employees, which makes fraud more difficult. Yes, this is a correct statement, and that is the purpose of preparing control accounts. There is no need to keep sales and purchase journal. This is not a correct statement because in fact sales and purchase ledger control accounts are prepared from the sales and purchase journal itself. There is no need to reconcile with personal accounts for customers and suppliers. This statement is not really correct because at the end, when you prepare the control accounts, the balance in the control account has to be matched with the total of balances of all the personal accounts, whether for customers or for suppliers. So there is a reconciliation needed to make sure that the control account is correct, or whether there are no errors in the sales ledger and the purchase ledger. So even statement number 4 is not correct. So 3 and 4 both are not correct. 2 we are sure that it's correct. 1 we are doubtful. So let's put a mark here. Now let's go to our options. So definitely wherever I see point number 2, I will try to choose my answer from there. So A has number 2, B has number 2, and D has number 2. So it is either A, B or D. Then option number 3 or statement number 3, I'm 100% sure that that's an incorrect statement. So wherever I see statement number 3, I will strike it because I know that's not the correct statement 100%. I'm very confident with that. So I will cross B, C and D because all of them have statement number 3. So I'm only left with option number A. So I will choose that, even though I'm not really sure of statement number 1, what they really mean, but definitely it cannot be B, C and D. So it is option number A. This is how you need to eliminate the wrong options in some cases. Even though you're not sure about statements, this can be done. So Doug received Going to the sixth one, Doug received his business bank statement. He updated the cash book and prepared the bank reconciliation statement. Which items appeared on the bank reconciliation statement? Bank charges will not appear in reconciliation. Customer payments by direct debit will not appear. Both of them go in the updated cash book, while uncredited deposits are shown in the bank reconciliation statement. So our correct option is option A. At 31st December, sales ledger control account had a balance of 19,100, while the total balance in the sales ledger, which is the total of debtors accounts, showed 20,900. Okay. Following reconciliation has been prepared after the errors were located. The balance in the sales ledger control account, they start, then credit sales omitted from the sales journal, so they're trying to add it. Okay. Discount allowed understated in the sales ledger. Okay, if discount allowed is understated in the sales ledger, it means because of this error, the balance in the sales ledger is at a higher level compared to sales ledger control account. So they're adding it to the sales ledger control account balance, which makes sense. Okay. What is the correct amount of total trade receivables as shown in the statement of financial position? So in the statement of financial position, you will be showing the balance in the debtors account, before or after correction of all the errors. So the 19,100 was the balance as per control account. Now in this, omitted credit sales were 1,600, so I will have to add 1,600. But this 200 was a mistake in the sales ledger. It was not a mistake in the control account. So this I'm not going to adjust it, because I want the balance as per corrected balance as per sales ledger control account. That's what I'm trying to calculate. So 20,700. An alternative way is, if you start with 20,900, which is the incorrect balance as per sales ledger, and you know that 200 discount allowed is not yet recorded, or it's understated. So what you can do is you can subtract 200 to give the effect of the understated discount allowed, so that the balance in customer's account reduces. You get the same answer, 20,700. Either way is okay, but don't try to put in this value. You can either try to calculate the balance as per corrected balance as per sales ledger control account, or you can try to find out the correct balance as per sales ledger. So option number D. At the year end, Victor had 100 units of inventory which had cost $12. Of these, 8 units received on the last day of the year and had not been paid for. Okay, doesn't make a difference because you're following accrual system. An additional 6 units were damaged and would be sold for $10 each once repairs to them totaling $20 were made. What is the value of inventory? So this statement, 8 units had been received but had not been paid for. This has no relevance in our inventory calculation. So out of the 100 units, let's separate the damaged units, which is 6, and the good units, which are 94. These good units will be valued at $12, which is the cost. But these 6 units, we will have to see what is the cost and what is the NRV. If I try to value $6 at cost, which is 6 into 12, $72. But if I try to find out the NRV, it will be sold for 6 into 10, 60, and repair cost is 20. So 60 minus 20, $40. Since NRV is lower, these 6 units will be valued at 40, while these 94 units, I will calculate 94 into 12, 1128. So the total value of inventory is going to be 1168, which is option number C. 10th one, at 31st December, the draft statement of financial position, we skipped the 9th one. 9th one, which items are treated as expenses in the income statement? Accrued wages at the end of the year. Yes, they are added to the wages. Prepaid telephone charges at the end of the year. Since they are prepaid expenses, they have to be deducted. They are not treated as an expense. Increase in provision for doubtful debts. Yes, that's an increase in expense. So our correct option is option C. 10th one, draft statement of financial position for a business showed total assets of $1 million. The following was then discovered. Increase in provision for doubtful debts, 5,000 has not been recorded. Closing inventory was overvalued by 20,000. Depreciation not recorded. What is the correct value of total assets? Very simple question. you have to subtract 5,000 because that reduces the value of debtors. Closing inventory overvalued by 20,000, you'll have to subtract that also. Depreciation 10,000 not provided, you have to subtract that also. So overall you have to subtract 35,000 from $1 million. So you will get 965,000, which is option number A. On what basis does a trading business produce an income statement? Cash received and paid out by the business in the year? No, because they don't follow cash accounting, they follow accruals accounting. Income earned less cost incurred by the business during the year? Yes, that's the correct statement. Revenue received less any cash paid out by the business? It is not correct. The difference between second and third is that they are saying in the third one that revenue that is received and cash paid. Again, they are focusing on the cash part. So our correct option is, a correct statement is 2. So our correct option becomes D. 12th one, a business provides the following information: revenue, opening inventory, closing inventory, purchases is given, goods are sold at cost plus 25%. The owner had taken goods for personal use but did not record this as drawings. What is the value of goods taken for personal use? If I want the stock drawings value, I will have to calculate my cost of sales. To calculate cost of sales using this information, what I can do is I can use the revenue 140,000 and I can use this markup 25% and arrive at the cost of sales. So cost of sales will be 140,000 divided by 125 into 100. So 112,000. Now when I know the cost of sales is 112,000, I can use this equation: cost of sales is equal to opening stock plus purchases minus stock drawings minus closing stock. So 112,000 is equal to 22,000 plus 120 minus drawings minus 24,500, and calculate the value of D here, $5,500. A business owner does not maintain full set of accounting records. At the end of the financial year, the following information is available: trade payables, opening, closing balance, return outwards, payment to trade payables. There were no cash purchases. Opening and closing inventory has remained the same. What is the amount of cost of sales? So for cost of sales, if you see the formula, it's opening stock plus purchases minus closing stock. They're telling you that the opening and the closing inventory is exactly the same, so this anyways gets cancelled. So in this case, cost of sales is equal to the value of purchases, and since there are no cash purchases, this only means the value of credit purchases. So using this information here, you can calculate the value of credit purchases using the purchase ledger control account. I will directly do it. So purchases will be closing balance 27,400 plus return outwards 1,000 plus 110,600 minus the opening balance 22,500. When you do the calculation, you will get your correct option. The provisions of Partnership Act apply if the partners do not draw up a partnership agreement, right? Which statement is true as per the provision of Partnership Act? Interest on drawings is charged at 5% per year, which is an incorrect statement because it is charged at 0. Interest on loan from partners is to be at 8%, which is again the incorrect statement because the correct interest rate is 5% as per Partnership Act. Partners are not entitled to salaries, so this becomes a correct option. And option D is profits are to be shared in the ratio of fixed capital, which is not correct. They have to be shared equally. So option C, 14. 15th one, Dua and Noor are in partnership, sharing profits and losses in the equally. Ratio is equal, so 1:1 is the old profit sharing ratio. They admitted Z as the new partner, and the new ratio is 2:2:1. On admission, the tangible assets were reduced in value by 20,000. So that's a loss on revaluation, and goodwill value was 60,000. So what was the net decrease in Noor's capital? So since there's a loss on revaluation, Noor's capital will decrease by her share of revaluation loss, so half of 20,000, which is equal to 10,000. So minus 10,000 because it's a loss. Then there is goodwill. So Noor's capital account will increase by her old share of goodwill. So half into 60, her capital will increase by 30,000 because this entry will be on the credit side of capital, that increases the capital. But for her new share, her capital will be decreased. So 2 by 5 of 60,000. New share in the goodwill, her capital will decrease, entry will be on the debit side. So that is 24,000. So how much is the total decrease? 4,000. So option number A. 16th one. The following information is available for a partnership: profit for the year before interest 15,000 and interest on partner's loan 1,000. So the net profit is 14,000. Interest on capital, this will be taken in appropriation account. Drawings will not be taken in appropriation account, it will be taken in current account. Okay. Which figure, profit figure, is to be appropriated between the partners? So when they ask you which figure is to be appropriated, what they are trying to tell you is that when you prepare your profit and loss appropriation account, which figure will you start your appropriation with? Which figure will you start your distribution between partners with? Obviously before the appropriation adjustments. So it is 14,000, 16C. 17th one, which item should not be recorded in statement of changes to equity? Bonus shares is recorded, dividends paid is recorded, profit from operations is not recorded because net profit is recorded, transfer to general reserve is recorded. So 17C. Following information has been extracted from the statement of financial position of a limited company: 6% debentures, 400,000 ordinary shares, 5-year bank loan, share premium, retained earnings. Okay. What is the value of total equity? Remember, equity means the share capital plus all the reserves. Equity is whatever that belongs to the shareholders. So 400,000 plus share premium plus retained earnings, because bank loan and debentures are non-current liabilities. So 525,000, which is option number A. On 1st Jan, X Limited had a share capital of 100,000 ordinary shares which had been issued at their par value of $1. There was no share premium. On March 1, a bonus issue of 1 for every 5 shares was made. On 1st June, company made its rights issue 1 for every 4 at a price of $1.5. All rights were taken up. How much was recorded in the share premium account? So earlier, at the opening, what were the number of shares that were outstanding? 100,000. Then the company issued bonus shares 1 for every 5. It means 20,000 bonus shares were issued. So after the bonus issue, total number of shares were 120,000. Now on this, they issued 1 for every 4. So rights shares is 120,000 divided by 4, 30,000. 30,000 rights shares were issued, and they were issued at a price of 1.5. Par value is $1. It means out of 1.5, $1 is the face value or par value, and $0.5 is the premium. So 30,000 into 0.5, $15,000 is the share premium amount that will be recorded in the account. So 19B. Following information is available for a business: sales, purchases, margin, markup, inventory at the beginning. What is the value of closing inventory? So if we get the cost of sales, we can get our closing inventory, because cost of sales is opening inventory plus purchases minus closing inventory, and we have opening inventory and purchases. Somehow we'll need to find our cost of sales. Since we have revenue 500,000 and gross margin 25%, so we can say cost of sales is equal to sales or revenue minus gross profit. 500,000 minus 25% of 500,000, 125. So it means 375,000 is the cost of sales. This, when we put in the equation, 375 is equal to opening inventory 20 plus purchases 365 minus closing inventory. So 385 minus 375, 10,000, 28. The following shows extracts from statement of financial position of a company: non-current assets, inventory, trade receivables, cash at bank, trade payables, bank loan repayable within 12 months. Even though it's a bank loan, but it's repayable within 12 months, so this becomes a current liability, keep in mind. What is the asset test ratio? Asset test ratio formula is take up all the current assets but don't include in that inventory, and then divide by all the current liabilities. So in our numerator, we are not going to take 35,000, we are going to take 23,000, we are going to take cash 12,000, we are going to take no other current asset. Okay, in the denominator we'll have to take all the current liabilities, which is trade payables 15,000 and the bank loan 40,000. So 35 divided by 55. So 0.64 is to 121A. The cost of direct materials is increasing. What is the effect if a business uses first in first out instead of average cost for inventory valuation? So when you use first in first out, your inventory, which is the closing inventory, is valued at latest purchases, based on the latest purchases, and since the material is increasing, it means the cost of latest purchases is high, cost is high. It means our closing inventory value is obviously high compared to if we use average cost method. So our closing inventory is the value of closing inventory is definitely going to increase. So it is either option D or option A, because only here we have increases. If closing inventory value is increasing, definitely cost of sales will decrease, because cost of sales works the opposite way. Cost of sales is opening inventory plus purchases minus closing inventory. So it definitely has to be D, because in A it is increases and it doesn't match. And if cost of sales decreases, profit obviously has to increase. So D is the correct option, 22D. Q Limited employs machine operators and supervisors. Each machine operator produces 100 units per week. One supervisor can supervise up to 10 machine operators and is paid 550 per week. Production is 7,700 units per week. Which type of cost is the supervisor's pay, and how much is their total pay per week? So options we have is either variable or stepped up. It definitely can't be variable, because variable means then the supervisor's pay has to vary exactly as per output, but it is not the case. Each supervisor will be supervising 10 operators. So it is not that for every 1 unit the supervisor's cost is going up. So it is not variable, it is stepped up cost. What do you mean by stepped up cost? Stepped cost or stepped up cost means cost that goes up until a certain level of output. So from 0 to certain level of output, the cost will be high. But then for next few outputs, the cost will remain flat. Then beyond a certain point, again, the cost increases. Then for next few units, the cost remains constant. Then it increases. So this is the case here for supervisors also. So one supervisor can supervise up to 10 machine operators. So if we get the number of machine operators, we will get how many supervisors do we need. So machine operators produce 100 units per week. Their output needed is 7,700. If each operator can produce 100 units, it means we need a total of 77 operators. But one supervisor can supervise only 10 operators. So for 77, if you divide by 10, you get 7.7. Obviously, you cannot have supervisors in fraction. So we will round this off to 8 supervisors. Each supervisor is paid 550 per week. So 4,400 is the salary. So option B. What is the limitation of absorption costing? It does not comply with accounting principles. It is not a correct statement, because as per in absorption costing, what do? We charge all the production overheads, whether variable or fixed, to the closing inventory, and that is the requirement of accounting also, or international accounting standards that provide the guidelines how to do accounting. So this statement is not correct. It does not take into account all cost of production. Again, this is not a correct statement. It takes into account all the costs of production, whether fixed or variable. It is not accepted for preparing published financial statements. Not a correct statement again, because absorption costing is actually accepted, and that is the correct way of presenting your financial statements, because inventory value in the balance sheet should always be valued at the total cost of production, which includes variable and fixed cost. It is not useful for improving the organization's performance, which is a true statement. Why? Because it is good for presenting information, but for decision making, absorption costing is not good, because The fixed cost is actually cost that you have to spend. So it has, when it comes to decision making, fixed costs become irrelevant, but absorption costing does not ignore fixed cost. So when you work on absorption costing, your decision making may be poor and it may not affect improve the organization's performance. So 24D. 25. The following information relates to one accounting period. Opening inventory is given, closing inventory is given, absorption costing profit and marginal costing profit. What is the overhead absorption rate per unit during the accounting period? So there is a shortcut to do such questions. The overhead absorption rate is the difference in absorption costing profit and marginal costing profit. That will be in the numerator, and in the denominator you will have the difference in inventories. So difference in opening inventory and closing inventory minus opening inventory. So if you take the difference between the profits, 284 minus 250, and in denominator 44 minus 40, so 34,000 divided by 4,000, so 8.5, 25D. So this is a shortcut to do such questions. The selling price of a product remains constant. In which circumstances will the break-even point in units decrease? Break-even decreasing means that you have to sell fewer units to achieve profits. So let's see what will help us do that. Increase in labor cost, that's not true. So if your labor cost increases, you'll have to sell more output to make sure that you cover the profit. So that's not a correct statement. Decrease in material cost, yes, when your material cost decreases, you'll have to sell fewer units to make sure that you earn zero profit, zero loss. Decrease in variable cost, yes. Increase in fixed cost, no. The moment cost increases, you'll have to sell more output so that you ensure that you have not gone into a loss, or you ensure that there's zero profit, zero loss. So 2 and 3, option 26B. A company makes and sells a single product type. The product is sold for $50 per unit and the variable cost is 30. Fixed cost is 500,000. How many units of the product does the company need to sell to make a profit of 300,000? So we did this in paper 11 also. The fixed cost plus the target profit divided by contribution per unit, which is $20. So 800,000 divided by $20, 40,000 units, 27D. A business makes and sells 3 different products, M, N and O. Following information is available. Selling price is given, direct material, direct labor, variable overheads, fixed overheads, and profit and loss is given. Each product uses the same direct material which is in short supply. So whenever there is a constraint in raw materials, you will have to give ranking. And the ranking has to be based on contribution per unit of direct material or per dollar of direct material. Whatever is the raw material that is in constraint, that has to be considered as a factor. So product M, N and O. First, what I'm going to do, I'm going to calculate contribution. Selling price minus material minus labor minus overheads. So 195 for M is the variable cost. So this is 195. So 240 minus 195, 45. Then we have N. The total of variable cost for N is 240. 280 minus 240, 40. And for O, 90 plus 100, 190 and plus 25, 215. 250 minus 215, 35. How much is the raw material cost in dollars? 110, 120, 90. Now I'm going to divide contribution. I'm going to take contribution divided by the raw material cost. So I'm going to get contribution per dollar spent on raw material. So 45 divided by 110.41. Then 40 divided by 120, which is 0.33. 35 divided by 90, which is 0.39. Then we are going to give ranking. Since N is highest contribution per dollar of raw material spent, 1, O is second and N is third. So this is the ranking, and accordingly we'll have to choose our options. So we have M first, O second, and N third. So option B. 29th, a business has the following information: break-even point 5,000 units, variable cost per unit $27, and contribution to sales ratio 40%. What is the total fixed cost? Okay, let's see. If contribution to sales ratio is 40% and I'm given variable cost per unit, can I try to establish a relationship between this? Yes. If contribution to sales ratio is 40%, it is obvious that the variable cost to sales ratio will be the difference, 60%. And if variable cost is $27, so I can say that the selling price will be $27 divided by 60%, because variable cost to sales or variable cost as a percentage of sales is 60%. So if 27 is the 60%, how much is 100%? So we get $45. That's the selling price. When I take this selling price and multiply it with the output that is sold, 5,000, I get 225,000. That's the total revenue. Okay. If I have revenue and I know that my contribution to sales ratio is 40%, I can multiply this by 40%. What I get is contribution, 90,000. And at break-even point, the contribution will always be equal to fixed cost, then only profit will be zero. So fixed cost will be equal to contribution, which is 19C. This may be a little longer method. There may be other ways to do it, but see, when an information is given, whatever relationship you can establish between the information given, just go ahead with the question and see if you get your answers. 30. Why does the business prepare budgets? To assess their non-financial performance. This statement is doubtful because budgets are prepared to plan for future operations and then to compare the actual performance versus the budgeted performance, but it's done for financial performance. So, okay, to control their expenditure, this statement could be true, but let's see. To strategically plan several years ahead, again, this statement can be true because yes, budgets are a plan for future, but the way they've said it, strategically plan several years ahead, probably yes, probably no, but depends on the other options. To value the assets and liabilities of the organization, this is definitely not the correct statement. This is not the correct statement. Now we are left with option B and C. If I see both the options, both might seem correct, but when I read option C, there's something really doubtful about this statement. The way they've said it, strategically plan several years ahead. So there's something really doubtful about this because it's not a strategic kind of plan. I mean, it's just a financial plan, and that too, they mentioned several years ahead. Usually no, budget may be prepared for 1 or 2 years in advance. So I think B is a better statement. 30B. We are done with paper 12. Now let's go to paper 13. Starting with question number 1. Mia has agreed to supply goods to a customer on sale or return basis. At the end of her financial year, the customer has not indicated whether they will keep the goods. So just to explain you what is the meaning of sale or return basis in case you don't know. Sometimes business may sell to a customer with the condition that you keep the goods. If you are able to sell it further, you can pay us for the goods, or else we take the risk and you can give the goods back to us. We will not charge you anything. So that way the customer does not carry the risk. So what happens is at the end of the year, customer has to confirm that we are keeping these goods and we will pay for it, so that the business knows whether the sale is really the sale. I mean, sales invoice is already prepared. So should we record that sales, or do we need to reverse that sales and record it as sales returns if the customer is willing to give the goods back to us? So here it says at the end of the year, customer has not indicated whether they will keep the goods. So here we cannot record revenue, because unless the customer is not confirming whether they'll keep the goods, we cannot record the revenue. So which accounting concept should Mia apply to these items in her financial accounts? Obviously it is about realization, because realization deals with revenue recognition. They've not asked anything about revenue recognition, whether revenue should be recognized, not recognized and all, but I've just explained you the concept in case such a question is asked. Which items should be treated as capital expenditure? Cost of a printer for an existing computer system. Yes, this can be treated because it's a printer. Your printer will be used for a long period. Rent paid not a capital expenditure. Repainting the wooden office door, not a capital expenditure. Repair cost to a car, not. So 2A. A business has a financial year end of 31st December. It purchased a vehicle on 1st Jan 19 for 30,000. Depreciation is at 20%, reducing balance on a monthly basis. Vehicle was sold on 30th September 2021, which is in 2019 they used it for the whole year, 2020 they used it for whole year, and in 2021, so 12 months, and 2021 they sold it on 30th September. So after using it for 9 months, they sold it. Profit on disposal is 3,000. No entries had been made to record the depreciation in 2021. What was the effect of not recording the depreciation for 2021 on the profit of disposal? So understand that they had provided the depreciation for 2019. They had provided the depreciation for 20, but they did not provide the depreciation for 2021. And after that, they calculated the net book value. Then they compared it with the sale value. They got the profit. Question is, what is the effect on this profit because of not recording the depreciation for these 9 months in 2021? So if you get the value of these 9 months depreciation by that much, the profit here is understated, because less depreciation means higher net book value, means lower profit. So let's calculate the depreciation for these 9 months. Since this is reducing balance method, they started with 30,000 in 2019. So you'll have to calculate depreciation for 2019, subtract. Then for 2020, you'll have to take net book value. Again, calculate depreciation for 12 months, subtract. Then whatever net book value you get, that will be the book value at the beginning of 2021. On that 9 months depreciation, we will calculate. How I would like to do it as a shortcut on the calculator, 30,000 into 80%. Why 80%? Because 20% is depreciation for 2019. So the 80% will be the book value at the end of 2019. Again, I will do multiplied by 80%. This gives me the book value after 2020, because another 20% depreciation. And on this book value, I will be calculating 20% depreciation into 9 by 12. So I get 2880. So 2021 depreciation 2880 is understated. Because of that, book value is overstated, and because of that, profit is understated. So option 3C. A trader bought a machine on 1st Jan 2019. He depreciated at a rate of 10% using straight line. He sold his machine on 1st Jan 2021 for 4,000. Profit on disposal was 200. How much did the machine cost on 1st Jan 2019? Okay, very simple. So sold the machine for 4,000. Profit on disposal is 200. So how much would be the net book value? 3,800, which is after 2 years of depreciation, 2019 and 2020. Each year's depreciation is 10%. So 2 years depreciation would be 20%, because this is a straight line. There's not reducing balance. So 10 years, 10% in first year, 10% in second year, 20% depreciation. Now this 3,800 is 20% of the, it's 80% of the cost, because 20% is depreciation. So it's 80% of the original cost. So you will get the cost as 3,800 divided by 80%, which works out to be 4750. So option B, 4B. Which item is recorded on the credit side of sales ledger control account? Discount received is not recorded in the sales ledger control account itself. Dishonor check is recorded on the debit side. Interest on overdue account is on the debit side. Set off vested contra entry is recorded on the credit side. So 5D. Bank column of the cash book showed a credit balance of 2915. Since it is in the cash book credit side, so this is an overdraft. So I'll put it as a minus number. This did not agree with the balance shown in the bank statement. Fine. It was then discovered that a bank transfer 150 from a customer was not recorded in the cash book. Okay. A check 450 received from a customer was not recorded on the bank statement. So this probably could be an error by the bank. A check 530 issued to a supplier was incorrectly recorded in the cash book as 350, but correctly recorded by bank. Fine. This is an error in the cash book. So error cash book, error bank statement. Bank charges 25 was not recorded in the cash book. Fine. When these items were adjusted, the cash book balance agreed with the bank statement balance. What was the balance shown on the bank statement? before any adjustments were made. So if we prepare our updated cash book and then the bank reconciliation statement, we can find out the bank statement balance. So what will be the updated cash book balance? We start with 2915 minus 2915 since it's a credit balance, overdraft balance. Then bank transfer 150 from customer was not recorded. We will record it, we'll add it. Then error in the bank statement, which is the second entry, we will not record in the updated cash book. Then third one, 530 check issued to supplier was incorrectly recorded as 350. So it was understated. A payment was understated. So we will have to deduct the difference, which is 180. And then bank charges was not recorded. So that will also be recorded. So updated cash book balance, when I calculate, $2940. Now, when I prepare the bank reconciliation statement, I'll start with my updated cash book balance to minus 2940, and this bank error, which is check 450 received from a customer, was not recorded on the bank statement. So since it is already recorded in the cash book and I'm starting with my updated cash book balance 2940 minus 2940, to arrive at the bank statement balance, you will have to remove the effect of this 450 in the cash book, which is minus 450. You have to remove it. So 3390, and since this is a negative number, debit 3390. So I just checked, there is a calculation mistake here that I made. This is 2970. So this becomes 3420. So now we get our option as 6C. Seventh one, the correction of which error would require an entry in the suspense account. So whichever is a one-sided error, with there we need a suspense account, entry in the suspense account. Sales invoice 45 was omitted from the sales journal. This is a two-sided error. Drawing 60 was debited in the cash book and was credited to drawings account. This is a error of complete reversal. So two-sided error. Vehicle repairs 100 were debited to vehicles account at cost. Error of principal, two-sided error. Wages 150 were correctly recorded in wages account but debited in the cash book. Cash book should have been credited but debited, so one-sided error 7D. The amount of expense for rent and rates recorded in the income statement for the year was 76,230. Following information was available: rent accrued, rates prepaid. Okay, how much was paid from the bank for rent and rates during the year? What you can simply do is just prepare a ledger account. Rent and rates, income statement, on the credit side amount is given 76,230. Rent accrued at the opening 4,000. So accruals at the opening is a liability, brought down 4,000, and at the end 6,500, so carried down 6,500. Rates prepaid at the opening, so brought down 770 and carried down 820. So now you can simply add up the credit side, subtract the amounts on the debit side, and you will get the bank figure, and then you can choose the correct option. Which statements regarding the financial statements of a sole trader are correct? Cash drawings for the year are recorded in the income statement, not correct. Gross profit for the year is shown in the SOFP, not correct. Prepayments only appear in the income statement, not correct. They appear in the balance sheet. Trade receivables appear in the statement of financial position. This is the correct statement, so 90. Simple question. 10. A business provided the following information regarding its first year of trading: credit sales, receipt from customers, irrecoverable debts, and contra, which is the set of entry. The net trade receivables recorded in the statement of financial position at the end of the year were 16,660. What was the balance on the provision for doubtful debts account at the end of the year? So what you can do is you can prepare a sales ledger control account. Credit sales is given, so on the debit side 93730, receipts 76,500 on the credit side, irrecoverable debts on the credit side, and contra on the credit side. Then you will get balance carried down. When you try to calculate, that balance carried down is the gross debtors, and the net debtors are given 16,660. So when you take the difference between gross and net, that is the balance in the provision for doubtful debts. Question number 11. Which items are recorded in the income statement of a sole trader? Interest payable on bank loan. Yes, it is recorded. Interest on capital. It's not an expense for the firm. It's not an expense that the firm spends externally. So not recorded. Transfer to general reserve. Obviously not recorded. So 11C. Summary of a trader's bank statement for the first year of trading showed the following: receipts from customers, cash, sales, takings banked. Okay, the amount deposited from cash to bank. So cash deposited into bank. This is this amount, that amount, 82,000. And this one is directly deposited, 25,000 directly deposited by customers into the bank. Trader took 2,000 every month from takings as drawings before banking the remaining takings. Trade receivables at the end amounted to 9,500. What is the total revenue? So total revenue will consist of cash and credit. Cash revenues will be the takings banked plus the amount of drawings withdrawn by the owner before depositing the takings. So 2,000 every month, so 24,000 for the whole year. So 106,000 is cash revenue. Credit revenue, receipts from customers, 25,000 plus the trade receivables at the end, which is 9,500. So 25,000 plus 9,500, 34,500. If there were opening trade receivables, I would have subtracted that. It is like preparing a sales ledger control account where you take the receipts on the credit side, balance carried down on the credit side, and then credit sales will appear as a balance on the debit side, the difference in the debit side. So that's why I added. So the total sales, if you add them, 140, 500, 12D. Jane provided the following information about a business: assets, total assets and current liabilities. During the year, business took a long-term loan of 10,000 and Jane's drawings total 12,000. Okay, what was Jane's profit for the year ended 2021? So profit can be calculated as closing capital minus opening capital plus any drawings minus any additional capital. So let's see, do we have the closing capital? For closing capital, we need to do assets minus liabilities. Total assets are given 119,000, but for total liabilities, current liabilities given is 11,500, and long-term loan that was taken during the year 10,000, that is given separately. So for total liabilities, we'll have to add these two amounts. So that makes it 21,500. So the capital will be 119,000 minus 21,500. 97,500 is the closing capital. From this, we will subtract the opening capital, which is 108,000 assets minus total liabilities. But for total liabilities, I'm just going to consider here current liabilities because there's no information given about non-current liabilities. So the opening capital becomes 100, 500, 100, 500. To this, we will add the drawings 12,000. There is no additional capital. So if we calculate, we get 9,000 as Jane's profit for the year. Which factors may cause a partnership to revalue its tangible non-current assets? In what situations will you revalue assets? Admission of a partner, yes. Change in profit sharing ratio, yes. Retirement, yes. So our correct statements are 1, 2 and 3, but I cannot see the options here. When I see the marking scheme, the correct option as per the marking scheme is 14B, but even change in profit sharing ratio will also require revaluation of assets and liabilities. So I have no clue why the marking scheme is saying 14B. According to me, the correct answer is 1, 2, 3. Probably it's a mistake on their side, or probably something that I am missing. So if you know the reason why 2 isn't the correct statement, why the correct option is B, you can comment it below the video. I will surely read it and I will also revert back. So yeah. 15. L and M were in partnership sharing profits and losses in the ratio 2:1. At 31st December 2021, the assets and liabilities of the partnership were as follows. Non-current assets at book value, inventory, bank receivables, bank. So these are all assets. Then trade payables is a liability. Capital and current accounts are given. Partnership closed the business on 31st December 2021, and at the date the following took place. Okay. What was else share of profit on realization? Let's quickly prepare a realization account. So first, closing all the assets on the debit side, 600,000 non-current asset. I'll take the total of all the current assets. Obviously, we will not close bank. Bank is never transferred in the realization account. This is realization account. Total of inventory and trade receivables, 90,000. On the credit side, I will close down trade payables, 20,000. Then reading the information, non-current assets were sold for 654,000. So on the credit side, 654,000. Inventory was sold for 80,000. All trade receivables are collected and trade payables were settled at book values. So 40,000 for trade receivables and 20,000 for trade payables. Realization expenses were 6,000. That appears on the debit side. So we need to calculate the profit or loss on realization. So taking the total on the credit side first. So 20,000 plus 654 plus 80 plus 40. So 794. From this, subtracting all the debit entries. So 690 and 26. 78,000 is the total profit on realization. They're asking for else share, which is into 2 by 3. So 52,000, option 15B. This is how you need to do it quickly in the exam. You can't take more than 1 or 1.5 or 2 minutes for this question. Question number 16. X, Y, and Z were in partnership sharing profit and loss ratio 5:2:3. Y is entitled to a salary of 18,000. Partners receive interest 6% on capital. Beginning of their capital balance are given. Profit for the year before Y's salary and partners interest is 140,000. What is Y's share of the total profits? So profit for the year was 140,000. From this we will subtract 18,000 Y's salary. Then we will subtract interest on capital for all the partners at 6%. So taking the total of all the partners' capital, 72,000 on this 6%, 4320. So minus 4320. We get the residual profits. So 118,680. On this, Y's share will be 2 by 10. Sorry, this is 117,680. On this, 2 by 10. So 23,536. Now the question is Y's share of the total profits. So if they had asked what is the Y's share in the residual profits, this would have been our correct answer. But what is Y's share in the total profits? 140,000, 23,536 plus the salary that he is entitled to 18,000 plus the interest on capital, 6% of his own capital, which is 1320. So taking a total of all these, 42856. 16C is the correct option. Question number 17. During the year, a business issued $1 ordinary share at a price of $1.2. Issue of new shares at premium. So directors also proposed a final dividend at the end of the year. Which balance in the statement of change to equity were affected? When new shares are issued at premium, ordinary share capital will increase, share premium will increase. But when dividends are proposed, there is no effect in the statement of changes to equity. So it's just first and second there will be an effect, and general reserve and retained earnings no effect. So option A, 17A. Following items were taken from the bank transactions of a company for the period: share issue proceeds, sale of non-current assets, dividend paid, increase in bank loan. What was the net increase in company's bank balance as a result? So the shares that were issued, this will add on to the bank balance. Non-current assets will add on to the bank balance. Dividend paid will be subtracted in the bank account, will decrease the balance. and the increase in bank loan will be added. So 35 plus 641, 41 minus 9, 32,000. So 18B. On 1st Jan, W Limited had a total revenue reserves of 122,000. During the year, the following took place. Dividend of 7,500 was paid. 10,000 was transferred to general reserve. Premises were revalued upwards by 19,800. For the year, W Limited made a profit of 32,000. What was the total of revenue reserves on 31st December? So this 122,000 is the opening balance. Basically, revenue reserves is any reserve that is available for distribution as dividend. So this will also include your general reserve. This will include your retained earnings, both. So when dividend is paid, that will be reduced from the 122,000. So minus 7,500 for that. Transfer to general reserve, it just gets reduced from retained earnings and gets added to general reserve. So as such, there's no change in the total revenue reserves. So this will have no effect. Premises were revalued by 19,800. This will just increase the revaluation reserve, which is not a revenue reserve. So no effect on the revenue reserve. And profit made 30,000. This will be added. So 120,000 plus 32,000. So which is 154. And 154,000 minus 7,500. So 146,500. 19C. What would increase the current ratio of a business? Current ratio formula is current assets upon current liabilities. So anything that increases the current assets or anything that decreases the current liabilities will increase the current ratio. Buying goods on credit for 2,000 and selling immediately for cash 3,000. So when you do this, your current assets have increased by 1,000 because you got inventory, you gave inventory, but in return you got 3,000 cash. Sorry, current assets is increasing by 3,000 while the current liabilities is increasing by only 2,000. So numerator is increasing by a greater amount compared to the denominator. Now you might feel that this will increase the current ratio, but it depends on what. See, I'll give you two situations to make you understand. Let's say the first situation, the current ratio is, let's say 50,000 divided by 50,000 divided by let's make it 10,000. That's the current assets, current liabilities. So current ratio is 5:1. On this we will apply the changes. So current assets will increase by 3,000, current liabilities will increase by 2,000, so 12,000. Let's calculate the revised current ratio. It is coming to 4.42. Earlier the current ratio was 5:1. So did you realize that even though the numerator is increasing and by 3,000 but denominator is increasing by less than 3,000, current ratio still did not increase. Why? Because it's the game of proportions. 3,000 is a lesser percentage or lesser proportion of the overall current assets compared to what 2,000 is of the total current liability. So denominator is increasing by greater percentage. That is why. Versus if you take another example, now I think you understood. If you take an example where let's say the current ratio is 10,000 divided by 10,000, 1:1 currently, and once we change this, we increase it to 13,000 divided by 12,000. Now if you see, the current ratio will be greater than 1:1. Why? Because 3,000 is a greater percentage of numerator versus what 2,000 is a percentage of denominator. So never get trapped in such questions. Maybe students will directly read the first option, see this and directly choose. The best way is to read all the options and then see. Maybe if all other options you feel are completely incorrect or you're confident that they're incorrect, then maybe it's the first option, but first read all the options. Paying wages of 1,000 in cash. When you do that, the current assets, which is the numerator, will decrease. So definitely this will not increase current ratio. This is the wrong option. Purchasing a non-current asset on credit. This will increase the current liability because non-current assets is increasing and current liability is increasing. When denominator increases, current ratio will definitely fall. It will not increase. So wrong option. Selling goods of 1,000 at cost price on credit. So when you do that, one of the current assets, which is inventory, okay, let me write inventory, is decreasing, but the other current asset, which is debtors, is increasing. by the same amount. So current assets remain unchanged, current ratio remains unchanged. So these three options are definitely not increasing the current ratio. So in this case, our current option is 20A, because I told you in option A, it depends what the current assets and current liabilities are. It can either increase or decrease. But since all other options are not correct, now we're confident that it's 20A. The following information is available for a business: sales, purchase, opening, closing inventory. What is the rate of inventory turnover? Formula is cost of sales upon average inventory. Cost of sales is opening 3,500 plus 21 minus 2,800. So 21,700 divided by average inventory, 3,500 plus 2,800 divided by 2. So that makes it 3,150. 21,700 divided by 3,150, 6.89 times 21B. Which statements about a semi-variable cost are correct? Part of the amount always changes for any level of output. This is a correct statement. Semi-variable cost consists of two elements. One is the fixed cost that does not change. The other element is the variable cost that keeps on changing. It will increase with increase in output, decrease with decrease in output. Part of the amount changes for a given level of output. No, then that becomes a stepped up cost. If it only changes for at a certain level of output, then that's not, the other element is not variable cost. The amount always changes for a given level of output. Yes, this is correct, because if one component changes for any given level of output, which is the variable cost, the overall semi-variable cost will also change because of that. So correct option is 22B, 1 and 3. A company has a financial year end of 30 November. It has no opening inventory at the beginning. During there, the following amounts of inventory are purchased: quantity and unit cost is given. Okay, sales for the period were 500 units. Inventory is valued at APCO method. What is the value of inventory? So first, how much is the closing inventory in terms of quantity? 330 plus 288 minus 500, because 500 is sold. So the quantity left is 118. Next, we will find out what is the average rate or average cost of the inventory bought. So 330 into 40, that was the total amount spent in buying the inventory on 30 March. Then we spent 288 into 50 for buying the second lot of inventory. That's the total cost of both the lots divided by the quantity purchased in total in both the lots, which is 618. So then you get the average rate. Okay, let's calculate this. $44.66 it is coming to. This we will multiply by 118. So 5269.9, or since rounding off to nearest dollar, 5270.23B. 24. A business has the following budgeted data: direct production cost. So direct production cost means it includes all the direct costs: direct material, direct labor, and all other direct cost. Indirect labor, that's an indirect production cost, or you can call it as factory overheads. Factory supervisor salary, this is also indirect production cost. Sales staff salary, this is not a production cost. So not a production cost. Depreciation on machinery for production, this is a production cost. Factory overheads. Depreciation on motor vehicles for delivery, this is not a production cost. And admin expenses, not a production cost. Just while reading the question, sometimes you can just look at the information bifurcated, and just analyze the information. It is helpful later when you read the whole question. To determine the selling price, business adds 40% on cost of production. So whatever is its production cost. See, what are the different types of cost? There is production cost, there is admin cost, there is selling cost. When you take the total, you get total cost. On this, the business can add profit and determine the selling price. But this business is not doing that. What it is doing is, it is saying that whatever is the production cost, on this we will add up 40% markup, and whatever we get, the amount, that it will be our selling price. So first we will find the production cost. 300,000, 20,000, 60,000 and 80,000. So when we take the total, we get 460,000 on this 40%. So we get 184,000. That's the profit element. So what will be the total selling price? 460 plus 184, 644,000. But this is for 50,000 units. So divide by 50,000, and they need it for 500 units. Because what's the selling price of 500 units? So 644,000 divided by 100. So 6440, 24C. A trader rents a vehicle for 10,000, which allows him to cover 20,000 miles per financial year. Okay, if this mileage is exceeded, an additional charge of $5,000 is made. Which type of cost is this an example of? It is not a fixed cost because the cost will vary as per the mileage. Semi-variable cost, I would have called this, but because fixed cost is there. But the other part, which is the 5,000 additional charge, this is not a variable cost as such. Because variable cost is when they tell you that for each additional mileage, this will be the cost per mile. But that's not the case. So semi-variable cost here is doubtful. Stepped cost, yes, we can say that this is a stepped cost because for increase in the mileage over 2,000, directly the cost will jump by 5,000. So this becomes a stepped cost. So probably the answer is 25C, and 25D, obviously it's not a variable cost, it's not a fixed cost, and it's not a semi-variable cost. So 25C. When might a business calculate its contribution to sales ratio rather than contribution per unit? So for break-even point, there are two formulas. One, if you calculate the break-even in terms of quantity, the formula is fixed cost over contribution per unit. And the other formula, when you want to calculate break-even in terms of revenue, in terms of dollars, then you will do fixed cost upon contribution to sales ratio. Let's see. When the break-even point needs to be expressed in units, no. When the business produces and sells several different products, no, irrelevant. When the value of fixed cost is uncertain, no. When there are limiting factors affecting production, obviously this is also not relevant. So looks like all the options are incorrect, but let's read the options again. Then the break-even point needs to be expressed in units. Definitely this is a no because formula clearly says contribution per unit. Option B, when the business produces and sells different products. Okay, this probably could be a possibility. Let's say their business deals in multiple products. Some are expressed, let's say, in units. Some are sold in units. Some are sold in kgs. Some are sold in liters. Basically, the measure of quantity of each product is different. But fixed cost is being done for all the products. So how will you calculate fixed cost divided by contribution per unit? You can't because the units are different. Yes, in this case, we can calculate an overall contribution to sales ratio for all the products and then do it because then the unit of measurement is same for all the products. It's in dollars. So yes, the option B is the correct option. Following information is available: selling price per unit, variable manufacturing expense per unit, variable selling expense per unit, total manufacturing overhead, total admin overhead. What is the break-even point in units? Fixed cost divided by contribution per unit. So 480, which is the total of manufacturing and admin, divided by 50 minus 30, 20 to 24,000 units. So 27D. K Limited manufactures a single type of product. The following budgeted information is given: selling cost, variable cost, total fixed cost, production and sales, quantity is given. How many extra units would the company need to produce and sell to increase the budgeted profit by 26,000? So whatever amount you need to increase your budgeted profit by, take that in the numerator and divide it by contribution per unit, because every unit you sell, you get some additional contribution. Let's say in this case it's 80 minus 28, which is 52. So for one unit you are getting $52 additional contribution. How many units would you need to sell to make it equal to 26,000 additional profit? So 26,000 divided by 52, 500 units. C. 29. M Limited manufactures and sells two different colors of paint. The following actual information is given: red paint, blue paint, total okay. Revenue, direct material, fixed overheads, allocated fixed overheads, profit or loss. Company is considering closing the blue paint department, using extra space to increase revenue in red paint by 20%. Variable cost will increase in the same proportion. What would be the change in total profit if this action is taken? Okay, currently the profit is 57,000. We will calculate the new profit and then we will calculate the change in profit. So okay, red paint department will get, blue gets closed, so we will only have red after that. Once blue gets closed, the revenue will increase by 20%. 350 into 20%, 70,000. So 420,000 will be the new revenue. Variable cost will increase in the same proportion, again 20%. So 180,000 into 20% is 36,000. So 216,000. So contribution will be 204,000. Fixed cost will not change. This 198,000, earlier red paint department was being allocated only 110,000, but once blue paint department is closed, all of that will also go in the red paint department. So 198,000. Had they said that fixed cost will increase or decrease by a certain amount, we would have considered that revised amount, but here nothing of that sort. So 6,000 will be the new profit, while earlier they were making a profit of 57,000. So what would be the change in profit? It will fall by 51,000. So 51,000 decrease. 29C. Why might a business prepare budgets? To encourage planning and decision making, correct. To improve coordination, correct, because budgets are interlinked. Each department is given their own budget, and when budgets are prepared, they are prepared keeping in mind the other departments also. So budgets of sales department will be prepared keeping in mind the capacity of the production department. So coordination is there. To monitor and control cost, yes, because once the budgets are prepared and later on there is actual performance, actual output has been produced, sold, so you can compare what was budgeted, what is actually done. You can compare them, you can see where costs have increased, where costs have decreased. Control of cost is possible. So 30A. So that completes paper 11, 12 and 13 of June 2022. So hope this is helping you, hope this will benefit you. If you have any comments about this, you can comment below. If you want me to do anything else, you can comment below. I'll see if it is possible, if it is feasible, and I will be also doing other papers also. So after this video, you can also look forward to paper number 21, 22, 23, and then A level 31, 32, 33. So thank you for being there. Don't forget to share the video with your friends also, so as to make sure that this series is benefiting maximum students. I'll see you in the next video.